Welcome to the Coin Bureau Weekly News Roundup. Here are the top stories in crypto this week. Crypto market pop. BTC, ETH and most altcoins jump after inflation figures come in lower than expected. What's next for the crypto market? CFTC versus Binance. US regulators take aim at the world's largest cryptocurrency exchange, calling its US operations into question. Why there's no cause for concern just yet. Ethereum upgrade imminent. Developers prepare for ETH unstaking in the face of regulatory uncertainty. Everything you need to know. AI under attack. Italy bans ChatGPT after Elon Musk and thousands of tech executives call on governments to pause AI development. How could this impact the crypto market? And we journey deep into the cryptoverse with the peerless Mr. Benjamin Cowen as our guide. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy. Nothing you're about to hear is financial advice. And here is the news. Last week, the crypto market posted some modest gains after the Personal Consumption Expenditures Index, or PCE, for February came in slightly lower than expected. For context, the PCE is the Fed's favorite inflation gauge. A lower than expected reading could increase the chances that the Fed will pause or pivot. And yet another driver behind last week's price action was yet another short squeeze from traders who had been aggressively betting that the crypto market would see a correction after weeks of rallying. So far, the crypto market has continued to surprise to the upside, but prices are starting to move more sideways. Now this is interesting because it's the same kind of price action we saw the weekend after Silvergate Bank's exchange network, or SEN, was shut down. If you watched our video about Silvergate, you'll know that the SEN was basically used by institutional investors to move money in and out of the crypto market 24/7. It seems that the shutdown of the SEN and the subsequent shutdown of Signature Bank's Signet has significantly restricted the ability for institutional investors in the United States to get direct exposure to the crypto market. The all-time highs on traditional futures exchanges like the CME is evidence of this. As reported by Reuters, the inability for institutional investors to access the crypto market directly has resulted in surprisingly poor liquidity and less market depth. In plain English, it's becoming easier to push the prices of cryptocurrencies up or down with less money. This means more volatility. It could also mean that we're going to continue to see strange price action outside of regular trading hours in the United States, namely on the weekends. Now, the practical effect of this is that it will become more difficult to use technical analysis because there will be less price action that can be analysed. Even so, TA could still work on longer timeframes where the price action is more apparent. As you can see, BTC completed a bull flag in March. Short-term indicators suggest BTC is losing momentum, but this could be because of the lack of liquidity and depth. Still, it's been enough to cause traders to go short. What's harder to explain is ETH's apparent weakness against BTC. March was the first time ETH closed beneath the Bollinger Band moving average against BTC since early 2020. Note how this moving average served as support during the bull market. This could foreshadow further lows for ETH and alts. Now, technical analysis aside, what BTC and ETH do in April ultimately depends on all the upcoming macro and crypto factors. There won't be a Fed meeting this month, so macro could finally take a backseat to crypto when it comes to price action. The problem is that the crypto factors are looking worse by the week. If you watched yesterday's video about the Biden administration's crackdown on crypto, you'll know it began in January this year. You'll also know the crackdown seems to have escalated after the White House published its economic report, which included a lengthy section about why crypto is bad. That's because the SEC issued a Wells notice to Coinbase less than 48 hours after the economic report was published. For reference, a Wells notice gives Coinbase 30 days to explain why it shouldn't be sued. Unfortunately, the SEC sues in 80% of cases where a Wells notice is issued, regardless of the response. If you've been keeping up with the channel, you'll know I've constantly been reminding you all that the SEC issued a Wells notice to Paxos over its issuance of BUSD in mid-February. It's been more than 30 regular days and more than 30 business days, which is why I expected an actual lawsuit to come soon. What I did not expect, however, was that the CFTC would come out of the left field to sue Binance and its CEO Changpeng Zhao just a few days after the SEC sued Coinbase, presumably as a part of the crypto crackdown's escalation. The CFTC is alleging that Binance and CZ broke US trading rules. What's concerning is that the lawsuit includes internal discussions at Binance which suggest that the exchange and its top executives were aware that they were in contravention of said rules. As with all stories, however, there are two sides, and both Binance and CZ allege that the lawsuit contains incomplete information. Regardless, the accusations alone have been enough to cause trouble for Binance's US operations, specifically Binance US. For starters, the CFTC lawsuit has reportedly resulted in the pause of Binance US's acquisition of assets belonging to Voyager Digital, a crypto platform which went bankrupt last year. Binance US also suddenly paused certain USD services and delisted BUSD stablecoin trading pairs. Note that second development may not necessarily be related to the CFTC suit. It could very well be related to the SEC's pending lawsuit against Paxos and the fact that Coinbase also recently delisted BUSD. In any case, the real Binance US bombshell was the resurfacing of Catherine Coley, the former CEO of Binance US, who appears to be working with the CFTC. If you're subscribed to my weekly newsletter, you'll know that Catherine had essentially gone missing in 2021, and it's not clear what she's up to now. Now, the good news is that Binance is unlikely to be affected here. That's because Binance itself is not based in the United States. In a worst-case scenario, Binance US could be forced to shut down as part of Binance's settlement with the SEC, something that's been reported as being a very real possibility. The bad news is that the lawsuit could result in more regulatory scrutiny of Binance elsewhere around the world, particularly in countries closely allied with the United States. However, as we've seen with Hong Kong, there are an equal number of countries that are looking to open their doors to the crypto industry, so it's not all bad. What is a big deal, though, is Ethereum's upcoming Shanghai upgrade. To quickly recap, Shanghai will make it possible for Ethereum validators to unstake their ETH and any accrued staking rewards. Ethereum developers recently finalized the 12th of April date for the upgrade, so be sure to mark your calendars. Now, besides the potential effects that Shanghai could have on ETH's price, the upgrade is important because it could have an impact on cryptocurrency regulations in the United States and elsewhere. For those unfamiliar, the SEC thinks that every crypto except BTC is a security. Not only that, but SEC Chairman Gary Gensler has repeatedly stated that proof-of-stake cryptocurrencies could be securities in need of strict regulation. Although Ethereum switched to proof-of-stake last September, ETH is still technically a proof-of-work asset. This will change when ETH unstaking is allowed. Given that former SEC Director Bill Hinman said ETH was not a security when it was still in its proof-of-work form, it's possible that the SEC's interpretation of ETH will change after the Shanghai upgrade. Now, whether the SEC would go after Ethereum is another question entirely, and I think it's very unlikely. Still, it's a big enough risk that some Ethereum protocols are taking precautionary measures. One example is liquid staking protocol Lido Finance, which happens to be staking almost a third of all staked ETH. Lido recently announced that it will be releasing NFTs which represent ETH unstaking requests. Now, this is a very small but extremely significant detail because NFTs have somehow not been subject to nearly the same degree of scrutiny as other crypto categories, including from the SEC. In fact, the SEC recently signed off on a crypto project called Freeport, which fractionalizes works of art into NFTs. Lido Finance's use of NFTs in the ETH unstaking process could therefore protect the protocol from regulatory scrutiny by the SEC. Come to think of it, this could also be why Uniswap wasn't targeted by the SEC while SushiSwap was, despite both being DEXs. All liquidity positions on Uniswap v3 are NFTs. Now, this begs the question of whether other liquid staking protocols and even cryptocurrency exchanges could start to follow suit to protect themselves from similar SEC scrutiny. I would hope that the answer is yes, but something tells me that the SEC will still find a way to go after the ones it doesn't like. So, this begs the question of which crypto companies and protocols the SEC doesn't like, and you'll already know the answer if you watched our video about Signature Bank's takedown. The SEC and other US regulators don't like any crypto projects or companies that compete with the FedNow payment system. While smart contract cryptocurrencies like Ethereum may not be seen as competitors to FedNow, stablecoins certainly are. This is why US regulators are actively targeting stablecoin issuers and why a crackdown is quite likely. Unfortunately, this crackdown may do serious indirect damage to ETH. However, this all assumes that US regulators are still preoccupied with cracking down on cryptocurrency, which may no longer be the case. AI is quickly becoming a much larger threat to government interests, and it's gotten to the point where even OpenAI CEO Sam Altman is concerned. If you watched our video about OpenAI, you'll know that it's the company that created ChatGPT, the famous AI chatbot which recently entered its fourth iteration. This fourth iteration is exponentially more powerful than the third, and the fifth iteration, expected later this year, could seriously disrupt society. It's safe to say that Italy isn't taking any chances. It recently became the first country to ban ChatGPT, citing a breach of data privacy rules. For those who don't know, the EU's data privacy rules are pretty strict. This means that we could soon see other European countries ban ChatGPT for the same reason. Obviously, privacy concerns pale in comparison to the other concerns with ChatGPT. The biggest concern relates to cybersecurity. ChatGPT could be used to hack into critical systems or even develop ransomware technology. It could also be used to develop convincing deepfakes on social media. These are just a few of the reasons why Elon Musk and over 2,600 other tech executives are calling on governments to put a pause on AI development. The open letter published by the Future of Life Institute explicitly states that the development of AI more powerful than ChatGPT-4 should stop for 6 months. It doesn't take an AI expert to understand that this request comes with its own set of concerns, notably that some countries and companies may continue to secretly develop more powerful AI despite the pause. This could result in, shall we say, less savoury countries and companies becoming unstoppable AI leaders. At the same time, there could be incentives for governments to allow AI to continue evolving with no regulations. In theory, flooding the internet with deepfakes is a bad thing because it leads to genuine disinformation. In practice, it could be a good thing from a government's perspective because it justifies forcing everyone to use KYC online. At that point, it becomes possible for governments to control what everyone does and says online. Now, this is an ability that many governments crave, especially those where trust in institutions is low. After all, the system exists to protect itself, and the elites will do whatever it takes to ensure that it stays intact. This is where cryptocurrency comes into the picture, and I foresee one of two scenarios. If other countries start to follow Italy's lead in banning AI, then this will tentatively take the wind out of the sails of the AI-driven tech rally that we've seen over the last few weeks. This will likely cause a crypto crash. If Italy is an outlier, then you can expect to see a rise in deepfakes on social media over the next few months. You can also expect to see the number of deepfakes go parabolic before the 2024 election in the United States. And of course, you can expect to see KYC requirements to use social media, not just in the USA. Now, believe it or not, but this second outcome could be bullish for cryptocurrency. That's simply because blockchains are immutable, publicly viewable ledgers containing transactions of immutable digital assets. In other words, cryptocurrency is the best way to protect the internet from AI-driven deepfakes. This means NFTs could finally have an actual use case besides sidestepping outdated securities regulations in the United States. But I'll believe it when I see it. Let's hope it doesn't get to that. So, with all that said, let's now turn to Ben Cowen's amazing analysis of the crypto market.
Hey guys, thanks for having me. Pleasure to be here as always. I thought today we would check in on the total cryptocurrency market capitalization within the context of the fair value logarithmic regression trend line. So the logarithmic regression trend line is this red line here, which is fit to all prior data of the cryptocurrency market cap. And the purpose of this chart is to show the ebb and flow from periods of undervaluation to overvaluation. And so we essentially just go back and forth, and that's the ebb and flow of the market cycle. Now, history would show us, based on what we saw in 2018, 2019, and 2020, and then in 2015, 2016, and also in 2012, history would show us that we have a habit of spending quite some time in these undervaluation levels before seeing a sustained push into a bull market that can lead us above the fair value regression trend line for more than just, say, a month or two, like 2019. What we'll notice is that in 2015, we essentially went sideways until we hit it. And in 2020, we kind of went down until we hit it. And that ultimate level was that lower green regression trend line, which more or less represents an undervaluation of 65%, which is somewhat different from where we currently are at about 42% undervalued. A better way to visualize that, I think, is to take the percent difference of the market cap and the fair value logarithmic regression trend line. And when you do that, you get something that looks like this. And we'll notice that this period this phase of 65% undervaluation has only occurred a few times in crypto's history. It occurred in March of 2020, it occurred in September of 2015, and it also occurred in September of 2010. Note that the bear market that was in 2012 did not reach that deep valuation of about 65% undervalued before really going into another sustained bull market into the overvaluation regime that lasted for more than just a few months. But we'll also notice that history shows us, like 2015, that we went sideways until we hit it. 2020 shows us that we went down until we hit it. And so the argument is that, well, if we go sideways until we hit it, it could take until sometime in early 2024. Of course, if we go down and hit it, then it could, of course, occur a lot sooner than that. But it's interesting how oftentimes we'll find ourselves, hitting this deep valuation territory sometime before the next halving. So again, either sideways into it or down into it. And then history shows us that that's what really kickstarts a more sustained move by the entire asset class back to the overvaluation territory. It also shows us that in general, 2015 was sort of a recovery year and a great year to get into the market, and so was 2019 and 2020, just like 2011, 2012. So while there's always a chance, of course, that we could push lower into the green regression band or go sideways until we hit it, the argument, of course, is that history will likely remember this as a general recovery year for the cryptocurrency asset class, and it's more or less just taking on a very cyclical behavior like we've seen in prior market cycles. Another way to visualize this, I think, is to overlay this summary risk indicator, the total market cap risk indicator. A couple of different risk indicators that we could look at. But if you look at total market cap risk indicator, this is what it looks like. So we go from periods of low risk to high risk. And if we overlay it just for Bitcoin, that accounts for on-chain data and social statistics and price statistics, we really see that ebb and flow of the cycle from deep value to overvalue, deep value over deep overvalue, and so on and so forth, right? So the whole idea is that the period, the year before the halving year, tends to be a recovery year. It doesn't mean we can't go up. It doesn't mean we can't go down, but it just means there's going to be quite a lot of chop, and we should more or less be expecting that for the duration of this year. So I'm sort of continuing to think of this year as just a year where the market will continue to stay undervalued, and perhaps by 2024 we can see a more sustained push. 2024, 2025, a more sustained push above the fair value logarithmic regression trend line, just like we saw in 2020 and 2021, and just like we saw in 2017 and in 2013 as well. But again, thanks for having me. It's always a pleasure to be here, and I look forward to again seeing you next week. Bye.
Thank you, Ben. Ben and I will be doing our weekly live stream on Thursday with Rob from Digital Asset News hosting us on his channel. So join two of the finest minds on crypto YouTube and yours truly from 9 a.m. Eastern Time, 5 p.m. Gulf Time. And this year's Coin Bureau live event will be taking place in London on the 10th of June. It's going to be a great day and there are still a few tickets available, but they're going fast. So link below to secure yours now. I can't wait to see you there. And that is all for today's Coin Bureau weekly crypto review. If you enjoyed it, you know what to do. Hit the like button, subscribe button, and bell icon too. If you're looking to help those gains grow, then the Coin Bureau deals page is where you should go. There are thousands of dollars in bonuses, trading discounts, and products to help you trade like a pro. Thank you so much for watching, and I'll see you all in next week's episode.